The offshore side is actually very easy to answer, because at the moment we don't have any interest in offshore, but I can come back to that. I can come back to that in a minute. Tufton Investment Management is a privately owned financial firm specializing in the fund management activities within the maritime industry. We currently have about $1.5 billion under management. The majority of that is in private vehicles for UK and US pension fund and other asset managers, which we run on a private basis. But we also have two public vehicles, Stainless Tankers ASA, listed in Oslo, which currently owns 9 stainless steel chemical tankers. And we also have Tufton Assets Limited, which is a listed investment trust vehicle on the London Exchange. It goes by the ticker of SHIP.L. We tend to refer to it as SHIP so as to differentiate it from Tufton as the investment manager. The strategy in SHIP is slightly different to Stainless in that it's the intention there is to invest in a diversified fleet, ocean-going cargo carrying vessels, and to really look for diversity in second-hand fleet dynamics, whereas Stainless is a very focused limited life J19 vehicle. I'm CEO of the Tufton Group. We have offices in London, Cyprus, Isle of Man, and Switzerland, and I also am CEO of Stainless Tankers in Oslo.
Moving on and looking at things a bit from the perspective of Tufton, what's your view on the shipping markets currently? Which segments stand out, and where do you have your biggest involvements?
Our main interest and involvement at the moment, and I say this because we look at diversified fleets and try and make sure that we're choosing the right sectors at the right time, the concentrations do vary over time. At the moment, majority of our investment is in gas, product tankers, chemical tankers, and smaller bulkers. So Supramax down on the bulker side, and on the tanker side, it's products. We don't have any LRs at the moment. It's MRs and handies, and J19s on the chemical side. Historically, we've had more interests in multi-purpose ships, in car carriers, in containers. We used to have a lot of container vessels. We sold all of those in 2021, 2020, early 2021, and we actually reinvested most of that into product tankers at the time. So that's the type of transition that we'll do, particularly within ship and within the private accounts. We'll change the dynamics of a portfolio to go into the sectors that we feel are generating value. I think at the moment it's pretty hard to tell where if you like, that sort of value really is. I think tankers have a bit of a way to go yet. I think we're in a bit of a downturn at the moment. I think everybody expected more of a seasonal uptick in tankers, but I think production cuts, etc., have eaten into that. And we've seen the sort of usual cannibalization that we do from the larger size into the product, and a little bit that we see from the product again into the chemical. I think we're still confident that those markets, particularly in the chemical and product sector, are coming back as we move into the winter months. Bulkers harder to tell, and I think current economic activity in China is not particularly supportive of a boom, at least in the bulker sector. But I think the thing to remember at the moment, particularly looking at the smaller tanker and bulker and chemical fleets, is that the age profile is getting older, as are we all. But also that so we have a bulge in age profile, and although the order book is growing, it's not enough to fulfill all of that fleet replenishment that's going to be needed over the next 5 to 10 years. I mean, that's a longer term view. Clearly, there'll be shorter term hiccups in that movement, but you look at the age profile of the world fleet and what was built in the years between 2002, China joining WTO, and 2012, 2013, etc. After the bulge from prior financial crash had actually delivered. That's all going to be coming up to 20, 25 years plus of age over the next 5 to 10 years. And that is a very, very large amount of replacement tonnage needed. So, caution on the demand side, but very good supply side dynamics is our general view at the moment.
So you mentioned the product tankers, and this segment has taken some heat in recent months. There have been several negative views on the segment. It's been said that refinery margins have been dropping, and now we also have the election in the US, which has brought Trump to power, and the market is speculating in an easing of sanction. I mean, it still sounds like you are quite optimistic about a recovery here on the product side. Can you go a bit more into detail on that?
Yeah, I think when we look at what's changing in the US, and clearly, that's a very big political event with the new administration coming in. I think they've been very vocal about supporting the oil and gas industry, and our view when it comes to that side, particularly on the gas side, but also I think on the product side, is that I think that we expect to see more US oil and gas exports, longer haul cargoes. Whatever's positive for the crude tanker market is also positive for the product tanker market. It sort of stops that overlap, and then even more so when we actually get to the chemical market. So I think that to the extent that swing tonnage in the product tanker market stays in the product tanker market and doesn't fall down into the chemical tanker market, and I think the way the supply side is positioned at the moment, I think that we can expect improving results as we move through the winter months and into 2025 in the oil and gas sector as a consequence of the new administration coming in. Clearly, we need to wait for January to actually see what they're going to do. We're trying to preempt that. I think it's different on the container side and on the dry bulk side. And I think that clearly containers, finished goods, semi-finished goods, they are more likely to be subject to various trade wars, if I can use that term. I think in the short term, we may see some very positive demand push as people try to, as actually imports grow to try and beat potential tariff implications of tariff. Dry bulk, again, I think that could be relatively exposed to introduction of tariffs. But I think nonetheless in both those sectors, and if we look back, to last time that we had this situation with tariffs, and particularly looking at there was a big thing about soybeans at the time, which is a very major dry bulk cargo, and China doing tit for tat tariffs, etc. on that. All that actually ended up happening is US exported all of its soybeans to Brazil, who repackaged them and sent them to China. At the end of the day, worldwide shipping works in the most efficient way that it possibly can do. You put an impediment in place, and be that an artificial impediment such as trade tariffs, or indeed be it a geopolitical event such as a war or such as a no-go zone in the Red Sea, etc., then that efficiency, which has grown over time, gets destroyed, and you've got to seek to do the same thing another way. Very few of us are going to limit our consumption of whatever it is because of what's actually going on in the world, be it a new administration, be it a war, be it physical or environmental issues in the Panama Canal or stuff like that, we still consume what we want to consume. It just means that those goods have usually got to travel further or travel in a more inefficient way of going from A to B to C rather than going directly from A to C. So I think generally, and I think this is counterintuitive and is not maybe understood by a lot of people outside shipping, that what is seen as adverse geopolitical and or environmental impacts are actually usually positive for shipping in the longer term. And particularly in the dry bulk side, tariffs, if it gets into the agricultural side, it lasts a season. You then replant somewhere else, or you replant different crops. That's what happened with soya before. So our general view on I was going to say a general view on Trump, but I won't say that. Our general view on the new administration is that it may be positive for shipping. Because I don't, I think the oil and gas sector will benefit and will work out how to handle the rest, which I suspect will mean moving more stuff further.
So you also mentioned on the dry bulk side, you mentioned a preference for the smaller vessels.
Yeah.
Why not the larger ones?
Well, good question. I mean, I think out of all of the trades, dry bulk is very China centric in the larger asset sizes. So in the Capes, in the Capes and the Kamsas, etc. Our investor base is not a typical shipping type investor base. It's very institutional. As I said at the start, UK, European, US pension funds, institutional asset managers, etc., that who already have phenomenal China exposure, in many other areas, and we don't want to put them into shipping and then just effectively double up on their China exposure. So we've had quite a conscious move to stay away from what we would consider to be China centric types of tonnage, so that we can say to investors, look, you're not just doubling up on China exposure here. This is a different product. We want real worldwide trading ships, which then leads us much more to the to the Supras and the Handy Maxes, etc., which are doing much more regional trades and a much greater mix.
So we in the Marhel community, we were quite early into tankers when tankers was still a contrarian kind of bet. And if you look at shipping today, do you see anywhere where there is still a potential of asymmetry?
In terms of low asset pricing versus the returns, yeah.
Versus upside potential, yeah.
Yeah, well, I mean, I do think it's tricky at the moment, and I don't think that is there in the tanker space just now. Having said that, the chemical tankers are still earning very, very good freight rates, and secondhand J19s, I think, are still relatively attractive, as long as you're not going too old on them. I think what we have seen, and what I still believe in quite strongly, we've seen a number of container ships with existing charters in place, which have been fixed over the last 18 months which have been fixed prior to the last 18 months, and so have longer term charters to them, which are severely out of the money. And I think if we do see any asymmetry around, it's because people value charters in a different way. I mean, everybody looks at it sort of differently. And I think we've looked at a number of opportunities recently of buying secondhand container ships well below market value because of a sub charter attached to that ship, which then actually very much de-risks your upfront investment, and then you're taking a chance that in 18 months time or 2 years time, whenever the charter actually runs off, that you've still got a good market, and then you've got it at a very low price, and you accept a lower yield in that period running through to that renewal. I think that's one of the few areas that we've seen at the moment. But as I say, we're still relatively keen on the chemical and product space.
Moving over to Tufton Assets Limited, you already briefly outlined the business model. Could you talk a bit about the pros and the cons of this model and the performance versus conventional shipping companies?
Well, yeah, I mean, I've been with Tufton for 22 years, and I've been in the financial side, investment side of shipping for all of my working life. So I've seen a few things. I've sort of seen a few things come and go, and a few companies come and go during that time. And I think there's and we've sort of designed Tufton Assets Limited, very much to be wary of the things that we've seen in the past that have gone wrong. Most shipping companies, in my mind, go bankrupt or go out of business because they stick with the same asset. And for a shipping company, of course, that's what it must do, because the shipping company is providing cargo management services, crewing management services, technical, commercial services with a speciality in a certain area. And we all know that the shipping markets go through cycles and go up and down. If you just stick with the same product the whole way through, you've got to get through every down cycle before you actually get to the end. And the average return on capital in shipping is around about 8%. So you've got a marathon to run to get through a whole lot of really bad dips to get your 8% at the end of the day. If you really want to make money in shipping, our belief is that when whatever sector you're in gets to that peak, you get out of it, and you get into something else which is in the trough, and then you get out of it when it's at the peak. Because we're, if you like, an investment trust, we're not an operating shipping company. We don't have third generation captains who knew my grandfather, etc., who I can't possibly get rid of, or I can't possibly think about owning a tanker because I only own Cape-size bulkers, or whatever it may be. We can just move. We can just switch and change. So we get to the finish line. Whether or not we get the 8% return or not is a different question. But I mean, we actually get to the finish line. I mean, SHIP, for example, has been going for 7 years now. We have given investors a total return of just under 15% on that product. It's currently paying a yield of around about 7.5%, but the overall return, realized and unrealized, is round about it's 14.7% at the moment. We've done that not because the shipping industry has given 14% plus return, but because we've got out here and we've got back in here and we've gone back in and out again. And that's what we do. The other thing that we do also, and that in SHIP, we deploy very little leverage. And I think, again, clearly that boosts returns, but it also increases the risk, and it reduces your chances of getting to the finish line, which is one of the other main issues why we see people failing, is taking on too much leverage, and then in that low cycle, they're forced to do things they don't want to do, i.e. sell the assets in the low cycle, which guarantees that you never get to the finish line, if that's what you're going to do. So I think those two factors, the diversity of the fleet, being nimble and being able to buy and sell and change the structure of the portfolio with limited leverage. We look for medium-term contract coverage, and we typically don't do joint ventures. So we're masters of our own destiny. I'm not going to let a JV partner nor a bank upset the apple cart because things go wrong. And I'll take a modicum of market coverage to see me through the harder times. But when you're unlevered, it's relatively easy. I mean, I think all of us in shipping know rates very, very rarely, for very, very limited periods of time, go below operating costs. So you can always get to the finish line. As I say, you don't know what your return will be, but you can get to the finish line. I think that's the main thing.
Let's move over to the chemical tankers, and looking a bit at your recent report, your third quarter report. You said that spot rates dropped a bit, and that it was related to the situation in the oil tanker space. Can you go a bit more into detail on how the declining rates in the oil tankers affect the chemical tanker side?
Well, I think it's pretty well known that in the less sophisticated end of the chemical tanker market, the more sophisticated end of the product tanker market, there's a high degree of swing tonnage there. Ditto in the product tanker market, you'll get a lot of particularly older tankers there trading in dirty cargoes as well. So there's a sort of switch over there. So one, the crude tanker market, which is the largest, influences the product tanker market, which again influences the chemical tanker market. And the chemical tanker market is relatively small. So, movements of, 10, 20, 30, 40 ships in and out of that sector actually has a big impact. And we did see over the last 6 months, although it's stopped now, we actually saw crude tankers trading in product. So we actually saw Suezmaxes, trading in product, being cleaned, and going through this. So we saw everybody cannibalizing off each other. I think that stopped now, and I think we have seen spot rates more recently going back up, going back up slightly. I think the product tanker market is stabilizing at the moment at a rate which does not incentivize product tankers to start eating into the chemical tanker trade. So I think that we've come to an end. I think we've come to an end of that, but we have come to an end of it at in a lower spot rate environment than we might have expected at this time, where we were expecting more of a bounce back as we enter the winter months. As I say, I think that will still come. We look at the pool. We look at the Womar pool results. So you may be aware that all of the chemical tankers in stainless trade in the Womar pool. We look at their results on a very careful basis, and they are continuing to increase November and December. Just looking at the current numbers, they're currently, we're trading now around about $20,000 a day, for November fixtures, which is nearly completely fixed now. So that's up $1,500 a day on where we were in October. And December again is although we're just starting to bite into the December coverage, but that is looking better than November at the moment. So I think we're back in that low 20s dollar a day range, as opposed to the high teens, which I think is where we will remain for the majority of next year in the spot market.
Could you tell us a bit more about why you chose to move into stainless tankers as opposed to, there are other bigger and more famous chemical tanker companies. There are different vessel types and so on. Can you go a bit into your preference for stainless tankers and
well, yeah, it's very simple, really, Carsten. To be honest, that we had a lot of J19s in some legacy private managed accounts, which were run on behalf of some UK pension funds. There was three different funds altogether here. They wanted out, not for any reasons to do with the chemical tankers or indeed the maritime market, but purely just a reassessment of their liquidity, of their risk base, etc. That they wanted out. This is sort of 20 months ago, or so now. I mean, we recommended against it because we felt there were some very good times coming in the chemical tanker market. However, their own internal, for their own internal reasons, they sort of said, no, look, we realize it may not be the right time to be exiting, but we need to get out. So we had a block of J19s that we could either sell in the S&P market, and there were quite a lot of them. So I think that would have slightly damaged the value of the ships we had, or we just start a new vehicle. And because we as Tufton and the partners in Tufton also believed very much in that market at the time, we put a lot of private capital of our own from the partnership into stainless tankers, together with the capital which is behind Womar, who was one of our operating partners anyway, Blue Ocean, who are the US money behind Womar. They also, together with us, and we clearly coordinated that with them on the basis that the ships went into the Womar pool, we, together with Blue Ocean, put in a substantial amount of the seed capital into the project. We were then joined by Klaveness in Norway, and we had about 50% of the fundraise that we needed done with 3 names, and then we went to the market. Then we went to the market for the remainder. So it has always been our intention to, if you like, keep control of these vessels and to keep together with Womar and to keep them in the pool, because we wanted to benefit. We wanted to benefit from what we saw as a rising market with this captive fleet, if you like.
You mentioned that you have a quite positive view on the chemical tanker markets. Do you think the whole space will perform well, or do you think there's a chance that you may outperform with your fleet profile?
Well, I don't think it's so much the fleet profile. I mean, because it is an older fleet, and many others have younger, have sort of younger fleets. I'm a big believer in Womar. I think they do a very good job in operating the pool, and they also, and I said this on the earnings call, although I wasn't drawn on the absolute numbers, but they have very good COA coverage, and they've been going through over the last 6 months a sort of round of renewing their contracts of affreightment and fixing those out over the next couple of years. And I can't quite, I had to be careful in saying, because clearly that's confidential information to Womar, but I mean, they've got round about 40% COA coverage now, and it's at a rate which is a couple of $1,000s a day higher than the current spot market. So I mean, I think that this, so whilst the spot market clearly will be variable, there's effectively 40% of the fleet is fixed, for the next 18 months or so. And that's one of the reasons I was asked on the earnings call for stainless. Somebody was inquiring about, whether or not we were looking at time chartering any of the vessels. There's no point in us time chartering out any of the vessels if I've got 40% COA coverage, which is at a rate which is higher than the current time charter, market. So, in effect, I've got 40% of the fleet fixed. So, and I know that number. I know it's higher, as I say, than the current. It's higher than the current spot rates by some way, and it's higher than the current market for time charter. And we have looked into that and looked at what those levels are. So, we'll stick with that. And I think also, you look at fleet growth. I mean, we think fleet growth over the next couple of years is maybe in the region of 3% in that J19, J25 type areas. So 3% demand growth. We've got a push, sort of coming in on the demand side. You don't need much of an extra push to tip that balance, and you've got, then you've got excess demand. I think one of the things a lot of people are missing in shipping at the moment, and I think there's always a lot of talk about, what's going to happen in Ukraine, with Russia, Ukraine, what's going to happen in the Middle East at the moment. That at some stage, hopefully, God willing, all of these conflicts are actually going to end. There is a phenomenal amount of rebuilding that's going to be needed at some stage in that whole region, and nearly all sectors of shipping will benefit from that, particularly on the chemical side. There's an awful lot of usage of chemicals in rebuilding infrastructure, and you know, I think that's an area, that's the type of demand push, if you like, an unexpected demand push, which could materialize, hopefully materializes in a way, over the next couple of years, that can just tip that balance. And when you've got limited supply growth and capacity and yard capacity, I mean, that's the other very important thing to look at on the order book, is that yard capacity is currently full. So, you know, and we're not where we were back in, you know, 2005, 2006, where you've got new shipyards cropping up all over the place in, you know, where there were cows feeding last year. That we have got a capacity constraint. So if we do have positive demand shocks in some of these areas of shipping, the short-term implication has to be that rates and prices take a large jump, and that's why we'll stick in this for the time being.
Is there anything you can say about whether the chemical tanker space has more downside protection, in the sense that the demand side is more robust than, let's say, the oil side or the dry bulk side?
Well, I think it's maybe, I think that the returns are maybe more robust than necessarily the demand side. I mean, as I say, it's a much smaller sector. You've got sort of 450 ships that will fit into your sophisticated chemical tanker fleet. And if you look back historically, freight rates, both in the spot and in the time charter market, have been a lot more stable in the chemical tanker fleets than they have in the product or in the crude tanker fleets, because demand has been relatively stable, and lo and behold, there has been a relatively stable number of ships within that area. Having said that, they haven't been very exciting. You know, I think we've gone through maybe sort of 2 decades where, you know, the average freight rate was sort of $13,000 or $14,000 a day. So TC rate was sort of $13,000 or $14,000 a day, and it was maybe up a couple of thousand or down a couple of thousand, and that was about the band. You could sort of draw a line through sort of 12 to 16,000, and for about 2 decades, that's where they operated. I think, you know, we have seen an increased demand. We have seen a reduction in the number of ships available, and we have now shifted that band. So I think our belief is that we now maybe still have a relatively robust setting of where the freight rates are going to be, but it's jumped from that sort of $13,000-14,000 a day maybe to a $19,000-21,000 a day. And we don't see it coming back down. We don't see it coming back down significantly from that level.
So, if I'm not mistaken, you also mentioned vessel sales in your latest report. Is this something that will affect your shareholder returns?
Well, the intention of Stainless has always been to be a limited life vehicle. I mean, when we launched it in March of last year, the intention always was a limited life, that we run these ships for the next 3-4 years or so, and then we actually start to dispose of them, because that's what, you know, it wasn't there as a growth vehicle. It's there as a full payout dividend yield. We took 2 older ships into the fleet at the back end of last year. We did so on the basis of no additional equity in the company. So we did it with cash resources in the company, and predominantly by increasing the debt facility within the company. And we had the scope under the debt facility because the value of the other ships within the fleet had increased. So if we are to sell ships now, and this is what we discussed on the earnings call, that we will look at selling those 2 older ships. They're coming up for 20. They're coming up for 20 years of age. We have quite a large docking program next year for the other ships within the fleet. These 2 ships are also due to be docked next year. The values at the moment are still pretty high. The values have remained high despite the spot market dropping off. So to us, it makes perfect economic sense to dispose of those 2 older ships. Clearly, the first priority of any proceeds will be to prepay the bank debt that is remaining. But after that, there will be a substantial amount of capital available, which will be returned to shareholders. So, does that impact our overall return to shareholders? I mean, it'll give them a one-off, but clearly, there's less ships within the fleet. But these were 100% debt financed. There was no additional shareholder money went in. So for these ships, and to the extent that money is then returned to shareholders, I mean, that's a complete bonus. So I think it's a very positive move. It's a very positive move for shareholders, and the actual amount of net asset value in those ships compared to the overall value of the fleet, because of their high leverage, although it's a welcome return to shareholders as a one-off, it's a relatively low number, so it won't impact the NAV materially.
Excellent. Let's move it back to our shareholder returns discussion. And I mean, it's not hard to find shipping companies these days with high dividends. And I guess my question is, how attractive is your company compared to peers in this respect?
Well, it depends if you like a 22% yield or not. I happen to, I have a lot of my own money invested in stainless, because I believe it is a very, very attractive return. And yes, there are some others, particularly in Norway, at the moment, who are also giving very high yields. I think our current yield on present share price is about 22% in stainless. I mean, clearly reducing the dividend is one of the last things that we're ever going to do. So hopefully the share price goes up a bit, so the actual yield on the share price may actually decrease slightly. But I think the important thing is going back to what I said before, about Tufton's strategy and Tufton's policy, but also about how we're actually treating stainless. This is not a lifelong company. In 2-3 years' time, all of this money is going to be returned to shareholders. So the way I look at stainless at the moment is, which may differ from how I might view other more established shipping companies on the Oslo Exchange, is that I've got a 22% yield, and I'm currently trading at slightly more than a 30% discount to the net asset value. So not only am I going to gain a 22% yield, I'm also going to make up that 35% discount to NAV. Now, I mean, you can look at other shipping companies, you can look at shipping companies and say, well, are they trading at a discount to NAV? Do they actually publish their NAVs, etc.? That's up to them. But are you going to realize that? Answer: very unlikely. Unless their shares trade back at that price, and then there's a liquid enough market to actually sell them. With stainless being a limited life vehicle, that at some stage in the medium term, that we're going to realize that NAV and we're going to get out. And that's what we said on the tin to begin with, and we do what it says on the tin. That's sort of Tufton's mantra, if you like. And if we think that there's more opportunity in chemical tankers, we'll launch stainless too, and we'll do the same thing again. And when the time's right, we'll sell it and we'll return the money. I mean, it's a very, very simple strategy. And to us, the last thing that we want to do with stainless is to say, oh, there's more opportunity in chemicals or indeed in products or whatever it may be, and start expanding that vehicle, because then we don't have that finite end that we've said there is. Then you don't get to realize your NAV because somebody wants to build a bigger and bigger shipping company, and you never get there. And so that's the way I look at it, is that there may be comparable yields around at the moment, but are there comparable yields with a discount to NAV where the company is saying it will be realized in a foreseeable future time? So I think that's the main difference, and that's why I believe it's attractive. That's why I've got my own money in there.
Quite a compelling argument. That takes me to my last question on stainless tankers. I remember in the beginning you mentioned, we quickly touched upon the offshore side, and you mentioned that you have, I think you said you have no involvement at this point, but you were going to get back to, you were going to say something more about it later on in the interview. So I guess maybe we could finish off by offshore, some thoughts there on where things are going, if you are looking to increase your stakes, get back into the segment again. Maybe we can look a bit into that.
Well, I mean, we Tufton used to have two different arms to it. We used to have a hedge fund equity trading arm, as well as the asset side of the business. So the asset side of the business became Tufton Investment Management, and actually the hedge fund trading side, it did a management buyout, and 5 years ago now became Oceanic Investment Management. They had a lot of experience in the offshore oil service side, oil and gas side of offshore, and had a lot of research in that area. And while we were together as the same company, at various times over the last 30 years, Tufton has had a lot of investments in North Sea offshore assets and elsewhere. I think we sold our last offshore assets in 2014, 2015, and we haven't gone back into it since on the asset management side. Clearly, I'm aware at the moment it's very healthy. I think there are a lot of opportunities in that area. We have looked more recently at the offshore sector with regard to the wind side and support vessels, construction vessels, crew vessels, etc. In that area, and I think that's an area where we may well take some of our private accounts, or indeed ship back into one of those areas. It doesn't necessarily fit our business model that well, because it's a lot harder to get medium-term contractual coverage, and I think that's always been one of the, if you like, scary areas of the offshore oil services sector to me. It is that you are very much at the whim of the contractors, of the explorers, etc., and that they do tend to drop you like a hot potato, when things aren't going, that well. Having said all of that, a lot of the people that we did have over the last decade or even 2 decades who had experience in that area have moved on. So we haven't got an in-depth team at the moment who've got expertise in the offshore sector. That won't stop us going into it when the time is right. We'll go and get the right people. That's what we tend to do, because we can be nimble enough on our feet. We haven't got plans to do so at the moment, but I think it is something which should be on the cards going forward.